What if I told you that when the market crashes, the real winners are those who shop, not those who drop? While the world sees a market crash as a disaster, the wise see a discount sale on Wall Street. Today, we're going bargain hunting for stocks with Warren Buffett. Hey there, financial adventurers. Welcome to another episode of Fun Financial Insights. Today, we're going to channel our inner Warren Buffett and learn how to spot the silver linings in stock market storms. So grab your umbrellas because we're about to make it rain opportunities. In 2022, the market plunged more than 18% but rallied over 24% in 2023. However, the rally isn't enough data to predict that the upward movement will continue into 2024. With the inflation currently high and a reduced likelihood of the Federal Reserve curbing interest rates, it is important now more than ever to decide what your line of action would be if the market is down. When the market's down more than a Monday morning, most folks see red. But not Warren. He sees a buffet of bargains, just like the Oracle of Omaha himself. Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. And that's our mantra for today. Did you know Buffett started investing when he was just 11 years old, and he regretted starting too late? What discourages most people from investing as early as possible or investing more is market crashes and how they erode their profits. So first, let's learn from past market crashes. What caused them? How did people react? And what your behavior should be next time there's a crash. The dot-com bubble was a period of massive growth in the use and adoption of the internet. It was a time when internet-based companies, or dot-coms, were the hottest investment on Wall Street. Like bubbles burst, it did. But what caused this bubble to inflate? Well, it was a mix of overvaluation of dot-com companies, an uncontrolled surge of venture capital, and a media frenzy that hyped up the tech industry. Investors were so captivated by the potential of the internet that they poured money into any company with a dot-com in its name, regardless of what its business model or profitability. The bubble burst when it became clear that expectations far exceed reality. The NASDAQ Composite Index, which had risen by 582% from 1995 to 2000, fell by 75% from March 2000 to October 2002. This caused market panic and massive sell-offs, leading to investor losses estimated at around $5 trillion. Despite the devastation, the market did bounce back. Historical data shows that after significant downturns, markets tend to recover over time. For instance, after the crash of 1987, also known as Black Monday, the markets returned to their pre-crash levels within just 2 years. Although that looks like a long time, it's better than taking losses of over 70%. Another financial crisis that not only shocked the U.S., but also global finance was the 2008 financial crisis. It was in fact also known as the Great Recession. There was a severe contraction of liquidity in global financial markets that originated from the collapse of the U.S. housing market. Leading up to the crisis, the Federal Reserve's interest rates were low, which encouraged banks to lend to subprime customers, someone considered to be relatively high credit risk for a lender. Subprime borrowers have lower credit scores and are likely to have multiple negative factors in their credit reports, such as delinquencies. This led to the creation of a housing bubble. When the bubble popped, it led to bank failures, government bailouts, and a global economic downturn. The S&P 500, a benchmark for U.S. stocks, declined by 38.5% in 2008. Household wealth took a massive hit, with an estimated $17 trillion evaporating as a result of the crisis. On average, home prices fell by 40%, contributing to a financial strain on homeowners and the economy. The crisis resulted in approximately 8.8 million jobs lost, and unemployment rates spiked to 10% by October 2009. From 2008 to 2009, the U.S. lost about $7.4 trillion in stock wealth, which averages to about $66,200 per household. The recovery from the 2008 crisis was more protracted, with the S&P 500 taking approximately 4 years to return to its pre-crisis peak. Lastly, let's talk about the COVID-19 market crash. In early 2020, as the pandemic spread, governments instituted lockdowns and businesses closed. The stock market experienced a rapid decline. The Dow Jones Industrial Average lost 37% of its value, and the global indexes also saw double-digit percentages declines. The crash was a direct result of the pandemic's disruption to labor markets and GDP contractions. Yet the market's resilience was on full display as it recovered swiftly, with the S&P 500 regaining its pre-pandemic highs in just 6 months, showcasing the fastest recovery in history. So, how did people react to these crashes? With fear, panic, and often by making hasty decisions like selling off their investments at a loss. But history has shown us that markets do recover over time. Now that we have seen these examples of how markets have crashed in the past, how do we predict if and when this might happen in 2024 so that we can be prepared for the opportunity? But before we look at these factors, don't forget to subscribe to our channel to connect with other like-minded people who want to take charge of their finances and forward their dream lifestyle. Now, here are some of the factors to predict opportunities or possible market downs. Currently, the S&P 500 is 14% above its expected average level for this quarter, hinting at potential overvaluation. 7 companies have provided most of the returns for the S&P 500 and the NASDAQ. These are known as the Magnificent Seven, and they include Google, Amazon, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla, which make up 30% of the S&P 500. While the upward movement of these stocks is a great thing, it's a concentration of growth on only the Magnificent Seven. Should one of them begin to miss estimates for their earnings, it could trigger a sell-off that would affect the whole market. High inflation can lead to increased interest rates as central banks attempt to cool down the economy. This can make borrowing more expensive and potentially slow down the growth of the economy. The U.S. has seen 3.2% inflation rate over the past year, while globally, we're looking at a projection of 5.8% for 2024. Inflation, the rate at which prices rise, eroding the value of our currency, it's the silent thief of your purchasing power. Inflation's ripple effect touches all corners of the market. It can squeeze corporate profits, lead to higher interest rates, and cause the stock market to stumble. Interest rates are the cost of borrowing money, set by central banks like the Federal Reserve. They influence everything from your mortgage to the strength of the dollar. As of now, the Fed has kept the federal funds rate steady at about 5.5%. Meanwhile, mortgage seekers can breathe a bit easier with rates below 7%. The 30-year fixed mortgage rates hovering around 6.82%. These rates are more than just numbers on a page. They're the pulse of the economy. Higher rates mean higher borrowing costs for companies, potentially slowing down investment and putting pressure on stock prices. When the market takes a nosedive, it's easy to feel like skydiving without a parachute. But fear not. Warren Buffett, the legendary investor who's seen more market cycles than a unicyclist at the Tour de France, has some timeless advice for us. Tip number 1, never lose money. Buffett's first rule is never lose money, and the second is never forget rule number 1. It sounds simple, but it's profound. Imagine you're a superhero whose power is to dodge financial kryptonite. That's what this rule is about, avoiding the pitfalls that can zap your portfolio's strength. It's not about never making a loss on paper. It's about not making investment decisions that lead to permanent loss. So think like a superhero investor. Shield your portfolio from danger and watch it flex its muscles over time. Tip number 2, buy wonderful companies at a fair price. Buffett advises buying wonderful companies at a fair price rather than fair companies at a wonderful price. Think of it as shopping for a car. You could get a flashy sports car that looks cool but breaks down every other week. Or you can invest in a reliable model that gets you where you need to go every time. Buffett's all about finding these reliable cars in the stock market, companies with solid engines, earnings, and excellent drivers, management. Your goal is that you don't just look for the discount tags, you should look for quality that lasts. Tip number 3, when it rains gold, put out the bucket. Buffett says opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Imagine you're a video game and it's raining bonus coins. You wouldn't run around with a tiny cup. You'd grab the biggest container you could find. That's what Buffett does when the market offers golden opportunities. He goes all in. So when you see a chance to invest in a great company at a great price, don't hold back. Grab your investment bucket and collect those golden drops. Tip number 4, build a portfolio to survive. Buffett emphasizes building a portfolio that can survive any market condition. He likens cash to oxygen, rarely thought about until it's gone. So imagine your portfolio is a spaceship. You wouldn't blast off without enough life support to get you through the journey, right? The same goes for investing. Keep enough oxygen, or cash, on hand to ensure that you can weather any cosmic storms, market downturns, and keep your investment spaceship flying high. Tip number 5, focus on value, not timing the market. Buffett reminds us that he focuses on value, not timing the market. He's not trying to jump in and out at the perfect times. He's looking for good deals. Picture yourself at an auction. You wouldn't bid on something just because it's about to be sold. You'd bid because it's worth more to you than the asking price. That's how Buffett approaches the stock market. He doesn't chase the ticking clock. He chases the value, and that's how he wins the investment game. Tip number 6, reinvest your profits. When you start making money, you might be tempted to spend it, but the Oracle of Omaha advises against splurging. Instead, he suggests reinvesting your profits. Imagine your earnings are seeds. You could eat them now for a quick snack, or you could plant them to grow an orchard of wealth trees. Buffett's way is the orchard. He reinvests profits to compound his returns, turning small saplings into a forest of fortune over time. Tip number 7, don't watch the market too closely. Buffett warns against watching the stock market too closely. The daily ups and downs can tempt you to make impulsive decisions. Think of the market like the ocean. If you're constantly checking the waves, you might bail out at the first sign of a storm. But if you focus on the horizon, your long-term goals, you'll sail smoother seas. I want you to remember that your path to financial success is right in front of you. The market may have downturns, but when opportunity meets your preparedness, instead of panic selling, you will be able to pause and make the best decision relative to your holdings. Thank you for being with me throughout. If this video has been helpful to you, remember to like, share, and subscribe for more valuable content. Let us make informed financial decisions together so that we can unlock the key to a brighter future. Have a nice investing time. Until then.